All right, we've got this recording. I want to welcome everybody today to our interview with Tom McKeon. Tom is the founder and chief investment officer at Clothier Springs Capital Management. He's an independent registered advisor, and Clothier Springs Capital Partners is a new entity launched to build a portfolio of direct private market investments on behalf of his clients. Now, Tom spent 11 years as an equity and foreign currency options trader market, in the Philadelphia Stock Exchange. For the last 25 years, he's been a portfolio manager, founding Clothier Springs Capital Management in 2010. Clothier Springs Capital Management advises private and institutional clients, managing innovative, globally allocated, asset-balanced, equity-hedged portfolios and discrete strategies that are low cost. Liquid and transparent in the pursuit of better investment outcomes for clients is one of Tom's mottos. Now, I just want to add a personal one here is Tom wants your money to work, from my knowing him, as hard and as safe as possible. Tom is one of the RIAs that look at all the options. He's not boxed in with just Wall Street stocks, bonds, and mutual funds, although he's very well versed in those assets and strategies. Tom also pays attention to alternative investments, as they're called today, such as tangible notes, mortgages, real estate, and private placements. Without me talking any more about Tom, I'd like for us to get started on here, and he can tell us a little bit more about himself. Are you ready, Tom?
I'm ready, Carl.
All right. Tell us a little bit about yourself that I haven't already talked about.
Well, briefly, I got out of school in 1978, and in 1980 I went to work at the Philadelphia Stock Exchange, and before too long I was a market maker, trading options in the equity options market and eventually the foreign currency options market. Did that from 1980 to 91 when the business started to get a little capital intensive and a little technology intensive, and with a few more mouths to feed under my roof, I decided to move towards a more stable and steady business model, and I went right into investment advisory work, and I've been doing that ever since 1992. Married to Carla, 34 years, and I have 4 adult kids. One of my sons is involved with the business and looking to be more involved, so that's a little thumbnail bio.
Hey, I appreciate that, and it kind of helps the people understand where you're coming from, and we've given you made you a presenter there. So I'm going to start with a few questions here. What is Clothier Springs Capital Partners?
So as you said, Clothier Springs Capital Partners is a new entity I just launched to make some direct investments in the private markets, largely real estate, and that itself is an extension of meeting you, Carl, 5 years ago and learning about self-directed IRAs, which I knew nothing about, despite having been in the business for 30-some years. And 5 years ago, I thought, hey, that's nice, but I don't have any need for that because everything I do is in the listed market, publicly traded stocks, bonds, funds, ETFs, etc. But as I continued to get more information, largely through your own CamaPlan educational efforts, I began to open my mind to different things, real estate investment, mortgage notes, things like that. And before too long, actually, after about 3 years, I thought, you know what, I could use some of that for my own portfolio, and if I could use it, my clients could use it. And the natural extension of that was to create a vehicle to house those investments. And that's exactly what Clothier Springs Capital Partners is. I'm in the process of just raising the money right now. I'm going to start with a $2 million raise. I've developed a number of relationships, again, through CamaPlan's networking and Strategic Investment Alliance networking. I found private capital looking for investment opportunities, and I found investment opportunities looking for capital. and you guys are ideally positioned in the crossroads of that. So it's been very helpful to me because unlike the listed markets where you can click a mouse and move $1 million or $100 million in a few milliseconds, the private markets are all find them yourself and invest them yourself. So it's a different workflow for me, but I'm doing it because I'm certain that there are really robust returns to be had here with very nominal risk. So that's what Capital Partners is supposed to be.
Well, no, I appreciate that, and thanks for the plug for CamaPlan and their network. I do, in this day and age, financial advisors and all the names and things that go after it, but for Capital Springs Capital Management or Clothier Springs Capital Management, you say you're the Chief Investment Officer. What does that actually mean? What do you do?
So what do I do? As Chief Investment Officer, I'm responsible for interfacing with the clients, whether they're private clients or public clients, trying to determine how much of their assets are going to allocate to my firm, whether it's just a sleeve, and I'm going to be responsible for a small piece of their money, or whether they just sold their dry cleaning business and they're giving me all their money, which means the recommendations are going to be a little different. And sometimes I'm just a portfolio manager and a product manager for clients, and sometimes I'm the asset allocator. I'm getting all their money, and so I have to develop a program for them. So the Chief Investment Officer looks at the range of opportunities. I must say that I do all my investing in the liquid markets now with exchange-traded funds. They have been enormously powerful in getting clients globally allocated, robustly allocated, and that allocation, that optimal allocation, really keeps risk to a minimum and presents opportunities that a lot of my colleagues in this business don't afford their clients. So my job really is to supervise the investment program for all my clients and implement it and execute it and trade it and rebalance it and monitor it and report on progress quarterly. That's the fundamental role of an investment advisor.
I got you. So I see structure is the strategy. Can you tell us a little bit about the strategy of Clothier Spring Partners?
Yeah, I believe after 30-some years in the markets that structure is what drives portfolio outcomes. Then structure flows from asset allocation. Structure flows from some of the private investment deals we've been looking at. There's a lot of people in our business who would like to tell you that they know how to maneuver in the markets. They know how to get in and get out and go long and go short, and usually that's just an effort to try and extract more fees from clients, and all the evidence in the world says that the data does not justify paying more for investment advice. So my mission is to give clients the best net returns, the best possible allocation, the best asset mix, keep their costs down. I need to earn some fees to keep my overhead above my head. But I'm in the business of giving clients the best net returns. And I do that with structure, portfolio structure, asset structure, and we keep turnover to a minimum and trading to a minimum. What we're really trying to do, Carl, is let investment portfolios hitch their cart to different market exposures, like U.S. stocks, like emerging market stocks, like municipal bonds, and so forth, and just let time and the natural bias of markets work for their portfolio.
I see on here 12 to 40% annually. How does that work?
So the range of things I've been looking at in the private markets provide what I have come to believe are returns ranging from 12 to 40%. If you do residential rehab, the target returns across the industry from my 3 years of due diligence are 30 to 35% returns per project. And that's when you buy the property at a discount to its eventual appraised resale value, you rehab it, and you remarket it. And those projects tend to take 6 months or less. So part of my challenge to bring this strategy to my clients is to say, I've been talking to you about 6, 8, 10% returns for the listed markets, and now I'm talking to you about 12 to 40% returns, and I don't want you to think that this is pie in the sky. These are the returns that come from the structure of doing that residential rehab. Now, there's other opportunities I intend to put in the portfolio, from commercial real estate to lending to developers, to alternative lending, to mortgage notes, and again, the portfolio is what's going to drive the bus. So it's not all going to be in one model, and it's not all going to be with one entrepreneur who needs capital. Again, diversification is the primary protection and the free lunch in our business.
Okay. No, I get that. For some reason, I thought that that's what you were doing. So, you know, give us the types of investments that are behind these returns that you've done your due diligence on. I see you got a slide up on that now, right?
Sure. Well, the types of investments are going to be residential rehab and sale, single or multifamily rental properties with a 10 to 14% expected income return. Commercial real estate projects, we've met a few folks that are looking for money to build apartment complexes or remodel apartment complexes. A little private lending and some mortgage notes, and they all have their own different expected returns and their own structural expected returns. So again, that's sort of the broad brushstrokes of what I intend to put in it. They're not all going to be in it in the same weights. I think the rehab I have targeted for like a 35% weight of the portfolio. I have the private lending targeted at 20%. Income properties at 10%, multi-unit housing at 10%. Now these are not set in stone, they're just policy targets, and of course as deals get invested in and monies get returned, as income comes in, as liquidity events happen, money's going to have to get redeployed, and depending on whether new opportunities exist at any given time, some of these sleeves will absorb more money or less money depending on the market at the moment. But that's sort of the general outline of the allocation for this strategy.
Okay, so your client-specific strategies, some will want part of these, some will want part of all of them, some will want one or the other. Is that it? How does the fund actually fit in for a specific client?
So this is going to be a fund like a mutual fund, and that's how I intend to treat it, so that everyone who purchases an interest in the Clothier Springs Capital Partners will get all of these investments. They're going to get a commingled return. So it's not a one-off deal, and I thought that was really the insight that I thought could bring something to the party. A lot of the people I've met in the private markets are looking to allocate money to a one-off deal, and I kept thinking in terms of a portfolio, so that this is going to be a portfolio of investments, and every client who gets a piece of it is going to get the blended return of what the portfolio delivers. And I think that's just the smartest way to approach it. Now, not every client is going to allocate to it, or if they do, not every allocation is going to be a static 10% or 20%. Depending on every client's unique goals and objectives and liquidity tolerances, or lack of liquidity, they'll take more or less. But that's a subjective decision. But everyone who's going to be in the partnership, Carl, is going to get the same return for the same time window.
I got you. So basically you're going out there and finding all these basically private investments that have good track records and good returns and putting them into a fund, and I assume it's mitigating some risk, but let's talk a little bit about how the fund is structured, and then as a follow-up to that, what are the risks?
Well, all the different sleeves have their own risk, but the theme here across my whole strategy, Carl, is that most of these investments are going to be secured by a real asset, a real property, a mortgage note, so that there's always collateral securing the investment, and at the end of the day, it's going to be the margin of safety where we buy the asset at a sufficient discount to ultimate value. And if need be, we take the property, or the loan, the mortgage note converts to take over the property. So what I'm trying to do is build in safety, through a real asset that's backing these investments, and safety through price discipline as well, and safety through diversification. So I'm trying to put as much structural safety into the portfolio as possible. Does that make sense?
No, it makes great sense, and I think you studying it for the past few years, I think you've got a pretty nice model here. I'm glad I'm on this interview today because I didn't quite understand exactly what you were doing, even though we talked about it. So that clears up a couple of things. So who can invest in this? Is there any limitations?
Well, it's targeted for accredited investors, but I'm going to use the loophole where I can take in 35 non-accredited as well. Originally, this was targeted primarily for my clients, and not all of them are accredited. Many of them are, but I didn't want to exclude any of my clients because they weren't accredited. So I'm going to take that up to 35 non-accredited, and the minimum is 25,000, and I think that's a pretty fair minimum for getting access to a diversified portfolio of private investments that I think have the potential to earn 20 to 25% annually.
Well, after time will tell for sure. How about self-directed IRAs? Have you introduced those to your clients, and can they, if they're accredited, use those?
Absolutely, and here again is where the CamaPlan education is so critical. To the extent that I can, I'm encouraging all my clients to use IRA money because this is an illiquid investment. It's a private placement. The investments the partnership is going to make are illiquid. You can't be out of them tomorrow or with a mouse click. So to the extent that IRAs have less of a need for liquidity, I'm encouraging my clients to put this investment in their IRA. Secondarily, the returns, which I think are going to be robust, are going to grow on a tax-deferred basis, which is the best of both worlds. So yeah, self-directed IRA, after the light bulb finally went on for me, Carl, about 2 years ago, I'm trying to make it all self-directed IRAs.
I think that's good, and it's a good way to talk about the liquid and illiquid money. So what are some other benefits for an investor on this?
Well, the flip side of the illiquidity risk is the premium that you get from accepting that illiquidity risk. That's going to show up right in the returns. Secondarily, these are not publicly traded investments, so they're not going to have the daily, hourly, by-the-minute price volatility that something like, say, Bitcoin might have. I'm going to strike a net asset value every month, and it's going to reflect the current status of the holdings and the cash in the partnership. And beyond that, though, I think that an allocation to this will enhance any client's overall allocation because it's bringing returns to the party, it's bringing a less volatile asset class to the party. So holistically and individually, this partnership, I think, is going to bring a lot to a client's outcome, and that's really what's driving this whole initiative for me. Does that make sense?
Yeah. No, it makes perfect sense. You just brought me back into like a deja vu moment where before the computers, you'd wake up in the morning, get the newspaper, and go out there and start searching the newspaper for your stock prices. And now you're basically saying, hey, all I got to do that is 12 times a year, once a month. And I'm so glad those days are gone. Even jumping up in the morning and hitting the computer and firing up your portfolio and looking at it just seems like it took out time and you had no control over it. So I never thought of that as a benefit, but now I have more time to spend doing the things I like. So I haven't seen this model too much in the past, which I'm kind of surprised at because I think you put a pretty nice package together here. Do you have any other competitors? You know anybody? How'd you come up with this idea?
Well, I don't know that I have any direct competitors for what we're doing here, which is to create a diversified portfolio of private investments. As an investment advisor myself, I see a lot of solicitations, and I've seen a number of solicitations for one-off deals the likes of which I expect to invest in for my clients. I got one today, which is I got a solicitation from an alternative lender saying, do I need money? And I actually sent an email back to them saying, I'm not a borrower, I'm a lender. If you're looking for money, let's have a conversation, but I'm not a borrower. So in that regard, I've seen some deals that are all one-off. You know, an apartment housing complex in Atlanta being packaged by a firm in Virginia. I've seen any number of them. They don't have any appeal to me. They tend to be overpriced. And again, I'm trying to bring the best net return to my clients. So what I don't want to do is be the third layer in an investment food chain. I want to create these strategies, take out as much of the fluff as possible, and give the best possible returns to my clients. So I can't say that I've seen anyone doing exactly what I'm doing. Certainly not at my price point.
Yeah, I haven't seen it either. I'm excited about this. I think it'll do well for both of us. So how do you differentiate yourself from all the rest of investment services and business models? Because I mean, I see financial advisor and they've got more letters after their name than realtors and doctors nowadays, and I can't really tell the difference from them, but you must do something to differentiate yourself.
Yeah, it's a great question, and there are certainly any number of people and business models that could take your money as a client and put it to use somewhere, and I think all people, all investors should understand, you know, what the business model they're giving money to. I'm a registered investment advisor. It means I'm a fiduciary. I act in the client's best interest as a matter of ethical preference and as a matter of regulatory requirement. This is why the Department of Labor requirement that brokers accept fiduciary duty saw so much of a pushback from the broker-dealer side of the world, the Merrills and the Morgans and the Wells Fargos. Guys who operate in a broker-dealer model don't really want to accept the responsibility to do what's right for their clients. So, you know, you take that whole universe away already. People who want advice for their money really should lean towards the registered investment advisor model. Beyond that, my model is really meant to be outcome and client oriented. I have a low cost, I compete on cost. I'm a low cost advisor. I compete on some special expertise, which is where I marry my experience in the options market to build strategies that are low cost, liquid, hedged, and transparent. I have a direct model, whereas many people you could allocate money to as a client, many of the advisors really are just relationship managers, and they turn right around and send your money off to a third party like SEI or InvestNet or some other entity that really does all the work for the advisor and leaves the investment advisor just with the client-facing role. Again, though, there's another 2-3 layers of fees in there that I don't necessarily want my clients to pay, because I can do that work, and I think I can do it better than most of those turnkey platforms. The other thing that I'm doing is I'm embracing the ETF product, because it allows anyone to invest in any discrete market exposure around the world for next to nothing. Some of the expense ratios in these ETFs are literally 2, 3, or 5 basis points. They're essentially free. If you want U.S. large cap exposure, there's any number of ways to get it, any number of tickers. But what it's led me to do, Carl, is give people a global allocation, an institutional quality allocation that years ago, not too long ago, would have taken 10 or 25 or 50 million for an institution to implement. Now people can have an institutional quality, globally allocated portfolio with $10,000 or $5,000. I think it's a revelation, and it's why you see so much money going into the ETF side of our business. That's why there's $4 trillion down at Vanguard now. It's why iShares and BlackRock is bringing in so much money, and that's why there's so much whining from the traditional mutual fund business model, because they're competitively disadvantaged now. But anyhow, that's how I try to differentiate my services versus the plethora of people out there who could ostensibly advise you or sell you something.
Pretty cool. Can you tell us now how people who want to learn more can contact you, please, before I lose it? And I also want to ask anybody in the audience if they have any questions they want to ask you, you know, if they can put it in the chat box and send it to us. We'll go over those here shortly.
Sure.
So
yeah.
Tell us a little bit how people could learn more from you and how they can contact you.
You can go to my website, clothiersprings.com. I hopefully have a number of ways to connect to me that way. You can go email info@clothiersprings.com or tfmckeon@clothiersprings.com. But yeah, that's the way to make the connection, and then the dialogue can go from there if people have an interest. Yeah, that's
Clothier Springs is CLOTHIERSPRINGS.com.
Yeah, correct.
You know, for the people that don't have the slides up in front of them, what is in it for you? All right, let me know.
What's in it for me? The partnership is just going to charge a flat 1% management fee. I think it's a fair compensation for the work that has to be done. It's not a hedge fund type of fee. I'm sort of opposed to their confiscatory fee structure. There's no incentive fee built into this. It's just a flat management fee. You know, that's any of my current clients are not going to be double dipped. They're not going to pay my advisory fee and pay the fee of the partnership. Everyone in the partnership is going to pay the fee. Any of my current clients that put money into the partnership will have their fee waived for that portion that's in the partnership. Trying to give clients the best net returns. Is that an answer?
Yeah, I think it is. What else should we know about this?
What else should we know? There's going to be unified tax reporting since it's a commingled vehicle. Clients are going to get one K1 tax report at the end of the year. They won't have to deal with multiple K1s from multiple deals that they've gotten into. The small minimum, I think, is advantageous. People can get into this with $25,000, where most of the deals I've seen individually have $100,000 minimums or more. And lastly, there's, I think, a lot of efficiency to be had here, that people don't have to go find their deals on a one-off basis. They can get into this strategy and get the benefit of the diversification in the private market returns for a pretty modest minimum, and go about their daily lives and not have to be their own chief investment officer in the private markets. They've offloaded that to me. So I think that's the general outline of why this is an idea that I think I'm willing to bring to my clients and prospects.
Okay, hang on a minute here. I'm trying to get a couple of questions. How long do you have to invest?
I want to have a minimum holding period of 1 year, just because the internal investments are going to have some different holding periods, varying from a rehab deal that might go 3 to 6 months to a private lending commitment that might be 3 years if you want to get their best rate of return. So I'm going to be juggling various liquidities and time horizons within the portfolio. So I want investors to commit to at least a year, just so we can see what the general ebb and flow of the liquidity and the cash flows and the distributions are going to be. After that, I'd like a fairly healthy window of notice, so that if somebody wants to get out, I can make sure I have the required liquidity for them to do that. So I'm trying to balance the liquidity constraints with giving people some access to their money. And again, if it's IRA money, hopefully people won't need their money back anytime soon. So I am trying to steer people towards using our IRA money as much as possible.
So you want them to you're looking for them to stay in the fund for 3 years, and then after that, like a 90-day notice, and they can take out their principal and earnings, I guess. But one of the other questions. Is that what I heard you say about? Is that about right, Tom?
Yeah, that's about right. To make a distinction, I'm not creating this to be a distribution vehicle. I don't want people to invest in it thinking I'm going to make monthly or quarterly distributions. I want to take all those cash flows from all the different deals and different business models and reinvest it in the portfolio to keep driving the portfolio value higher. So I want to make that clear that this is not going to be a quarterly or monthly distribution strategy.
Yeah, no, that was, yep, no, that's exactly kind of one of the questions Ben had there for it. So I think you answered both of those questions at that point. So just to reiterate what you said is any proceeds or earnings you're going to put back into the fund, and then after 3 years people can start taking out their portions or selling their shares or something like that.
After 1 year, I'm going to allow investors to request some liquidity.
Okay.
Yeah, after 1 year. Some of the internal investments will be 3 years, but some of them will turn over in 3 or 6 months, and some of them are going to be distribution vehicles for my partnership, so that some of my investments in the partnership are going to receive monthly and quarterly distributions, which I'll either have to redeploy or earmark for redemptions.
Okay. So yeah, I mean, what I would say to people asking these questions is get with Tom and go through your specific circumstances and scenarios, and you'll help them figure out what's the best plan for them, and then you'll also have an idea of what you're going to do with the fund. Is that right, Tom?
Absolutely, yeah. And where it fits into your overall asset mix. Even if I'm not advising a client on their other monies, I just want to make sure that I understand where they're coming from, and that how much they put in the fund is appropriate, for their own situation as well as the fund. Again, one of the things I didn't say is I don't want any one investor to be more than 20% of the fund. I'm only trying to raise $2 million here, and I've had a couple of my own clients say, why wouldn't I put all my money in this deal? And I said, well, that's a fair question, but again, allocation drives the bus, and there are some liquidity constraints to be aware of. But that conversation has to be had before any money gets placed in my partnership.
Okay, and this is whether you have new clients or existing clients, you'll end up with these discussions for them. At this point, I just want to give your phone number out, Tom, so that if people want to call you, please don't call us for questions about any of these assets. Tom's your man. We don't sell anything. We don't recommend or do any of those types of activities. We're strictly bookkeepers here so that you can make these types of investments. But Tom's phone number is 610-933-3925.
That's correct.
Let me repeat that, 610-933-3925.
You do it.
And what else, Tom, do you think we should know before, if you have time to cover anything? What's your favorite restaurant in Phoenixville?
Oh, that would be the Great American Pub, Carl. It's become the go-to place in Phoenixville, which by itself has become a quite trendy little entertainment spot. Live music, dining and drinking, and remarkable. Really, it's had a transformation. It's literally risen from the ashes like the phoenix. If I That's my little plug for Phoenixville.
Well, so that's your second office, it sounds like.
Yeah, that's my executive lunchroom.
Yeah. The other thing is, what book would you, what's one of your favorite books that you think the audience should maybe read?
That's a great question, and without putting too much of an academic spin on it, I like to tell people to read Moneyball. People are probably familiar with the sports metaphor in our world, and Moneyball, if anyone doesn't know, was written by Michael Lewis, who spent some time on Wall Street before he decided to write for a living. And Moneyball, which came out at least 15 years ago, was clearly a metaphor for stock picking. And for anyone who doesn't know, it was about the story of Billy Beane with the lowest payroll in baseball trying to find players who could actually play baseball, but he could afford them. And to me, the metaphor was about trying to find good investments at a cheap price. And that message did not get lost on anybody in Wall Street. But it's a great backdrop for really trying to understand security selection and valuation discipline. And it's a pretty good read on top of that anyhow. So that's probably the recommendation I would steer people towards.
Okay. I appreciate that. So one more time, TF McKeon, TFMCKEON at clothiersprings.com.
Correct.
Phone number is 610-933-3925. Wow, you even put your cell phone up here. I'm not going to read it over the air unless you want us to. And website is clothiersprings.com for more information on this new fund and capital partners. Tom, I really appreciate you taking the time today with us. We will have this on our website so others that need it that weren't able to be here today can listen to it. And if
these
you
things are available. Carl, let me just interject. These things are available on my website. If anyone goes to my website, they can see the link to open a self-directed IRA, and they can also see the three documents I put up on my website regarding capital partners. It's an investor letter, an executive summary, and this presentation that we made available here on this webinar today. So anyone wants to go see them, they can download them themselves and cogitate about them. Okay?
Yep, no, I think that that's great. I appreciate you explaining exactly what this is, and I like the way you put a lot of self-directed individual plans into quote mutual fund type of fund. Interesting.
Awesome. Yeah.
All right, have a good day, and thanks everybody for listening. I appreciate it.
Thank you, Carl.